Hi, everyone. I'm Robin Gregg, the CEO of RoadSync. Thanks for joining us today. We thought we would share with you some interesting developments in tax planning that would be relevant for our tow and repair customers. There are a lot of big bill changes over the early summer earlier this year. And before the end of the year wraps up, we thought it made sense to talk to you a little bit about it and also give you some ways that actually RoadSync's platform can help you with tracking some of these items. But I'm not the expert in taxes, so we've actually invited some folks to join us today who will run through most of the material. This webinar is being recorded and will be available via video recording afterwards. So if there's folks that should be here or couldn't make it, we're going to send that out to different folks, but also you can forward it to other people in your company if they need it to see this. So I want to introduce Matt Abraham and Rosie Mercedes from CLA. They are a firm here, a tax advisory firm here in Atlanta, and I'll let them introduce themselves.
Thank you, Robin. Good afternoon, good morning, depending on where you are. I'm very grateful that you guys are able to join us today. My name is Matt Abraham. I'm a tax principal here in our CLA Atlanta office. And a little bit about CLA. We're a national firm, got about 130 offices and about 8,000 employees. So we've got offices, in California all the way to Rhode Island. And the unique thing about CLA is even though we're a large firm, we really focus on privately held businesses. So individuals like you as business owners, this is our sweet spot in serving companies. And we cover probably 12 different industries from manufacturing to technology. And we're really industry driven in how we approach serving our clients. And, the unique thing about CLA is we can serve privately held businesses, but we have deep expertise. So myself, I'm not a tax compliance preparer. I focus on tax consulting matters, and we have a great partnership with our other partners and CRLs at the firm. We're always collaborating so we can provide great advice to our clients. So with that being said, I will turn it over to Rosie to introduce herself.
Great. Thank you, Matt. My name is Rosie Mercedes. I'm a CPA out of the Atlanta office. So Matt and I work directly on a lot of clients. I lead our private client tax team, which is a team that specializes with individuals, estate, trusts, and give tax returns. We also work with a lot of family limited partnerships and consult with small businesses as well. Our next slide, and this is just for a little bit of disclosure. This is just meant for informational purposes. It's not meant to provide direct tax advice. Tax advice is very unique for your individual business or individual profile. So we definitely encourage you to get the information you grab from today's webinar and share that with your tax consultant, tax professional to go through and see what's applicable in your field. And now to Robin.
All right, so we're going to go through a couple things today that we think are all relevant to businesses like yours. So first of all, we obviously just introduced ourselves. We're going to talk about the equipment and business owner tax benefits. We're going to talk about employee tips. I think that one of the things we've seen, especially in the towing and roadside repair markets, is that people are doing tipping more frequently. And, there's now a new tax law around tax on tips. So we're going to talk a little bit about that and how that might be relevant for your employees. I'm going to talk through other individual tax provisions that might be relevant to you as a business owner, and then just give you some tips on implementation and action items. And we have time for Q&A throughout the entire session. So if you have any questions, throw them in Q&A. You don't have to wait till the end. It'll be more interesting if we kind of make sure that we situate stuff around things that are interesting and relevant for you. So please feel free to chime in and I'll figure out how to weave them into the conversation. So we'd love to hear people's questions.
Awesome. Thanks, Robin. So getting into the meat of today's presentation, I want to start out about some key tax business law changes regarding bonus depreciation, Section 179, and the standard mileage rate. So before getting into bonus depreciation, want to talk about this at a macro level because we know this audience, you're not, well versed in tax, right? You probably have a cursory level of knowledge. So we want to talk about this at a macro level, provide some examples. But since it is tax, there are going to be some nuances that are technical in nature that we will, dig into. To Rosie's point, take this back and work with your tax advisor, or we can have a conversation after this presentation where we can talk about things in more depth. But when we talk about bonus depreciation, first you have to ask yourself the concept, what is tax depreciation? And so depreciation is a cost recovery concept. So if you purchase an asset, in a perfect world, you want to deduct that expense immediately, and that's where bonus depreciation comes. But traditionally, it's over a cost recovery period. Simple example, there's more nuance to it. If you buy something for $100,000 and you have a 5-year recovery period, it would be $20,000 deduction every year. So if you look at bonus depreciation, that basically allows you to fully deduct the cost of any qualifying asset in the year that you actually purchase it. So the scope of the asset, it's tangible personal property, machinery and equipment, heavy machinery and equipment, but probably in your guys' world, office assets, computer, furniture, vehicles, certain real estate improvements. So generally think if it has a cost recovery period of 20 years or less, then it's subject to bonus depreciation. The benefit of bonus depreciation is you're going to get better cash flow with respect to claiming bonus depreciation. As mentioned in my initial example, if you're recovering that over 5 years, you're only getting 1/5 of that deduction in year one. But if you get 100% of that in year one, you can redeploy that cash to other areas. And all this came down, because of some legislative changes, as Robin mentioned at the beginning of the presentation. One big, beautiful bill act, we'll commonly talk about it as OB3A, that basically has allowed 100% bonus depreciation. This bonus depreciation concept has been introduced years ago, and it had a phase down where it was eventually going to be phased out in 2027. So what I mentioned was OB3A. It's going to give you 100% bonus depreciation. Now it's for any qualified property that's acquired after January 19th, 2025. I'll talk about the acquisition date on the next slide in a little bit more depth, but that's a key date to keep in mind. It's a shift from the previous tax law. As I mentioned, it was scheduled to be phased down. So in the 2025 tax year, it was 40% bonus depreciation, 26 was going to be 20%, and 2027 was going to be 0. So the eligible categories, just kind of reiterate what I mentioned, tangible personal property, off-the-shelf software, anything with the cost recovery period of 20 years or less. So if you purchase a building, the building itself is not going to be eligible. You'll assign what's called, for non-residential real estate, 39 years. So essentially, the tax policy behind this, getting back to 100% bonus depreciation, is really encouraging investment. As a business owner, right? If you're able to get an immediate deduction for heavy machinery and equipment, that's going to incentivize you to probably purchase more CapEx. And as I mentioned, this is permanent part of the tax law, and which is really good because it gives business owners like yourself certainty on making CapEx decisions. As I mentioned earlier, acquisition date, January 19th, 2025. Any assets that are eligible for bonus depreciation, it has to happen before that. Not knowing which side of the aisle you are from a political perspective, but the current administration selected that date because of the inauguration date. Didn't want to give the previous administration any credit with respect to bonus depreciation. As I mentioned earlier, the phase down was going to be only 40% in 25, but that's changed. Now, if you purchase anything from Jan 1 to January 19th, or you have a binding agreement before January 20th, then you are subject to the 40%. So look at your contracts and see which you're eligible, because obviously this is all going to be for your 2025 tax return, which will be filed in 2026. Careful documentation is probably going to be key here, because I think a lot of people are going to, increase their CapEx investment. Not sure if this will ever get, examined from the IRS, but it's going to be key from a documentation perspective. So that is bonus depreciation. There's another concept called Section 179. It's a tax deduction, and it kind of works in conjunction with bonus depreciation. So it's really out there to benefit small businesses. We'll talk about how much you're entitled to from a 179 perspective, but it's basically you can fully deduct the purchase price of qualifying assets in the year they're placed in service. You can do with that with bonus depreciation, but you're limited in scope as to what is eligible for 100% bonus depreciation. Again, it's a cash flow improvement play. The more you can expense in your current year, the higher likelihood you reduce your taxable income and you pay less taxes. They made this deduction in place a while back. I'll talk about it in the next slide of what the dollar amount is, but again, just to spur more investment and remain more competitive with 179. So the deduction limits and phase outs. For 2025, they're allowing a 179 deduction of $2.5 million. And that, when you compare it to in prior years, it was 1.22 million. So you can see a significant jump with respect to what the 179 deduction is. And it is inflation adjusted, so it'll increase each year in the successive years. Now, there is a phase out. If you are using 179 and you start purchasing more than $4 million worth of eligible property, it'll start phasing out dollar for dollar and completely phases out at 6.5 million. So you can see the number, the delta between 6.5 and the 2.5 million. Again, it's a permanent part of the law and inflation index, so that will be great in terms of applying this provision in a go-forward basis. And then bonus depreciation, as I mentioned, you can apply 100% bonus depreciation if you exceed your 179 limit. So that's a great feature. So whenever you do your tax planning, you have to figure out which assets you want to claim 179 and then use bonus depreciation so you're not losing out on the benefit. Eligible property for this deduction, it's going to be, again, tangible personal property, machinery, equipment, certain improvements such as HVAC, fire protection to non-residential real property. So if you've got a building in place, you can apply 179. And then this third bucket, probably is very useful to this audience, is if your vehicles are used for 50% or more for business, SUVs and trucks that weigh over 6,000 pounds, so the gross vehicle weight rating, GVWR, can qualify for 179. Property must be placed in service during the tax year, and then you have to fill out the appropriate form to claim this 179 benefit. Usage and limitations, again, clearly it has to be more than 50% used in the business. It's, you can deduct it from your taxable income, but you cannot deduct more than your business taxable income. And then finally, states, you have to look at it. Every state tends to operate differently. So sometimes they go part and parcel from a federal perspective. For example, Maryland and Minnesota impose additional deductions when it comes to a 179. So I want to round out this part of the conversation by going through some examples. So the first one, you got a moderate capital spend and you fully utilize 179. So if you're a small business and you purchase $1 million of qualifying equipment in 2025, your business taxable income is $2.2 million. So you have more taxable income than you want to take a 179 deduction. Since your $1.8 million is under the $4 million phase out, you're allowed the full 179 deduction. So in this case, you've got $1.8 million, $2.2 million of taxable income. Now, once you take that into account, you have $400,000 of taxable income. I mentioned something about bonus depreciation. You can use this in conjunction, but there's no need to rely on bonus depreciation because you can get the full $1.8 million reduction in 2025. So in this scenario, you've got a high capital spend. The business acquired $5 million of qualified property that you can apply 179. Your taxable income is $3.3 million. So in this situation, you've got more 179 eligible expenses. But as I mentioned, you can only, deduct up to taxable income. In this situation, you're $1 million over the phase out of the $4 million phase out. So basically, your 179 is reduced 2.5 minus the $1 million, so 1.5 eligible. So in this case, you got $5 million of basis, 1.5, you got 3.5 that is still, eligible for deduction, not for 179. This is where you look at it and says, okay, you know what? Bonus depreciation, are these assets eligible for bonus depreciation? If it is, then you can get the other 3.5 million. So in this case, you're getting a 1.5 million, $179 deduction, and a $3.5 million bonus depreciation, 100% bonus depreciation. So in this case, you add it up, aggregate, you basically get $5 million. Your taxable income is $3 million. Whatever you don't use in current year, you carry forward into future years. And then this last example, I want to talk about a vehicle. So if you acquire an SUV, right, for your business, and it's more than 50% used in the business, and it's a gross vehicle weight rating between 6,000 and 14,000 pounds and cost 80 grand, well, you can take 179 for this SUV, a deduction, and there's general rule to point to about 31,300 is what your deduction is. So now you've reduced the basis of that $80,000 SUV by 31.3, the remaining basis of 48,700. This is where you apply bonus depreciation. So in essence, you can quote unquote write off the entire 80,000 for that SUV with a combination of 179 and bonus depreciation. Now, just always confirm the rules for a specific vehicle as to what you can take it. Definitely SUVs, heavy weighted vehicles, they figure that's more used in business as opposed to, say, a luxury sedan. So just work with your tax preparer as to what the true deduction is before claiming that on your tax return. So with that being said, I will turn it over to Rosie to talk about some additional owner benefits.
Great, thank you.
Well,
Before we jump on to that,
see if there's any questions from the audience before we move on to the next section, because obviously that was a lot of information. Certainly recommend folks use it to have conversations with their tax professionals, but any questions from the audience? Doesn't look like we have any yet. All right, Rosie, why don't you just keep on plowing through?
Not a problem. And if you guys have questions, please feel free to populate that in the Q&A, and we can answer that as we go through. So while we're talking about vehicles, we wanted to bring up a couple of ways for vehicle deductions. One is the standard mileage rate, which is very easy to use. We recommend this mostly if you don't have a lot of mileage for a vehicle. The rate increased from 67 cents to 70 cents. This mileage rate includes everything associated with the vehicle. So it includes depreciation, gas, maintenance, for you to be able to allow deduction for the vehicle using the standard mileage rate. This is a rate also you could use if you're reimbursing employees for maybe using their own personal vehicles to conduct some business. Maybe if you're meeting with a client off-site or going to scope out contracts and they don't have a business vehicle, you can use the standard mileage rate to reimburse them for the use of their own personal vehicle. Now, the next slide, this is where we dive into a little bit more as to the actual method. So Matt, if you can move forward on the next slide. Thank you. So this is the next method to deduct vehicle expenses. It's actually all the expenses associated with the vehicle. You would still need to track the mileage. Normally on commercial trucks and like, for example, tow trucks, you're not anticipated to use any kind of personal miles. But if you have a vehicle that can lend itself for maybe some personal use, you definitely want to keep track of that so you can back out the non-business use of the vehicle expenses. But here you would be able to deduct the purchase price if it's not purchased outright, where you could take bonus or Section 179. But then if this is being under a lease agreement, you could deduct the lease expenses, all the maintenance, fuel, insurance, and whatnot. Usually, if you're incurring a lot of mileage on the vehicles, the higher the actual expense method would be most advantageous and definitely something you want to use. The standard mileage rate would be useful again if you have a low mileage vehicle. Again, for example, reimbursing employees for using their own personal vehicle. On the next slide, we wanted to talk about self-employment tax. So the self-employment tax or the SE tax cap increased to 176,100. This increases the amount for the Social Security cap as well. So this is at 12.4%. So if you're an employer and the employee, you're paying the full component of the self-employment tax, both the employee part and the employer part. There is no cap on the Medicare, and there hasn't been a cap for Medicare at all. That's still at the 2.9. If you're looking at a W-2, this would be broken down by 6.2% for Social Security, 1.45% for Medicare. For high earners, and they define high earners, if a W-2 is more than 250, there is a 0.9% surtax. Excuse me. Now for QBI, and I want to discuss a little bit of QBI. QBI is now made permanent, and QBI does not affect self-employment tax. But QBI is qualified business income deduction. This is if you're a owner have pass-through income, where you could deduct about or almost 20% of your business income as an above-the-line deduction before you even calculate tax. And this depends strictly on your entity structure. So if we go to the next slide, here's just a little bit of information on entity structure. So if you're sole proprietor or a single member LLC, you would be paying self-employment tax on the net income. So on the entire amount, there's no way to split the income between salary or distributions to try to have any kind of tax savings for self-employment tax. You still qualify for QBI, but the entire self-employment tax would be eligible at that area. If you're structured as an S corporation, here you have a little bit of wiggle room as to minimizing your self-employment tax. You need to consider paying yourself a reasonable salary. And it's a little bit hard to define what reasonable salary is because IRS doesn't indicate, hey, if you are in this position, this will be considered reasonable salary. What we do take is a rule of thumb of how much would you pay to replace yourself to cover all the duties that you're doing for your business for a reasonable salary. And at the very minimum, it has to be more than your highest paid employee. It would be hard to prove reasonable salary if it's, $20,000 a year and you have employees making $200,000 to $250,000. The benefit there is that you could take the rest as a distribution. So it would save you on at least a Social Security portion of that. And if you're a multi-member LLC or partnership, active partners generally don't save on self-employment tax earnings, but limited partners do on passive income. Now, we wanted to talk about.
So Mercedes, before we move on, we did get a question on vehicle expenses. Can you write off on the vehicle write-off? The question is, can you write off miles and gas and tolls? I guess are all those things included in the actual expense method, or can you talk a little bit about that?
Absolutely. So for the actual expense method, you are keeping track of the miles, but that includes everything. You're keeping track of tolls, parking, keeping track of fuel. So definitely gas is one of the biggest things. You're keeping track of insurance and everything associated with the vehicle. So oil changes, if you're changing tires, if you're doing just routine maintenance, you're keeping track of all of that.
Thank you. Hopefully that answered the person's question.
No, you're welcome. So the next item we wanted to talk about were tips. In the towing industry, although tips are not mandatory, I'm sure it's greatly appreciated and welcome when you're helping somebody out. in a jam if they're on the side of the road and you're towing them to safety. So tips, this is only, the deduction works is only for 3 years. It's for 2025. You heard that correctly. So it's made retroactive to the beginning of the year and goes all the way till 2028. And this is where there's no tax on tips, where it winds up being an above the line deduction. The maximum you can have in there is 25,000. So there's not an opportunity to say, oh, well, my employees all get paid on tips. So you have to kind of manage and watch out what their wages are. But it does have an income phase out. So if your employee have a modified income of 150,000, single, or 300 as married finally joined, there would be a phase out, and it would be completely phased out at higher income levels. So tips are reported separately on the W-2, but this is something definitely you want to watch out for. So if you go to the next slide, Matt, there you go. What is included is tips. So it's anything that's a voluntary cash tip. This can be listed on a credit or debit card receipt. It can be tips done via mobile app or any kind of digital platform. It could also be considered pool tips or shared tips. Important notes, Social Security and Medicare taxes still apply for tips. So when we say no tax on tips, what it's really referring to is federal income tax and state income tax. It must be reported on the W-2. There is a spot on the W-2 for reporting on tips, but that may be changed on overtime, as there is a stipulation for no tax on overtime. So there may be a newly redesigned W-2. We haven't seen that yet, but that we anticipate for that to come out in December, late December, early January. You also need to maybe designate that on the additional forms, and definitely on the 1099K and 1099 NEC. You want to make sure if you're receiving payments through a digital platform that there's a clear reporting that, hey, this is the amount that you're receiving for services, and this is the amount being received for tips. And again, just to reiterate, this is effective, even though the tax bill came out on July 4th, this is effective beginning January 1st, 2025, all the way through the end of 2028.
And this is probably a good time to mention, RoadSync now does have the ability to collect tips, and we do employee level reporting so that you will have that documentation that you need, not to only make sure that you get the money to your customers, to your employees, but also that you can track it for sort of compliance and tax reasons as well. So, you know, we have this most of this documentation. We obviously don't integrate directly into your payroll system or do payroll, but we do provide that data that you would need to be able to do the things on this page.
Thank you. So those in the restaurant industry already keep track of tips, but in the towing industry, it may not be something you keep track of separately. It may just be part of compensation. So this is a great time to go back through your documentation. Go back through your payroll systems and double check and see how is that being tracked. You may have to go back and make an adjustment to go retroactively, because again, this law didn't come in play until July 4th. So you have to go back and see how you can capture what you have reported for tips, or maybe have some kind of year-end summary where you could indicate that and share that with your employees. You definitely want to do daily logging of the tips to avoid any kind of administrative burden, you know, when you're issuing W-2s by the end of January of next year. And you definitely want to make sure you update this in any kind of employee handbook so that they're aware of, hey, this is why you're separating the tips from their normal salaries, as there is a benefit. Great. So I felt like we had to provide a little information about the law changes for individuals, because as owner operators, eventually, if you're reporting all this stuff on your individual tax return, we wanted to go through some of those provisions. One of them is the lower tax brackets, the tax brackets that were incepted from TCJA, which was back in 2017. are going to remain the same. Originally, those tax brackets where the highest tax bracket was 39.6% was supposed to go back up for 2026, prompting a lot of us in the industry to reach out to clients and make them aware, hey, you may need to adjust your withholding and your estimated tax payments. But that's now made permanent with the highest tax bracket at the 37%. I alluded to before about qualified business income, or QPI. That is permanent, set for 20%, and it will be adjusted and indexed for inflation starting in 2026. So for business owners that have pass-through income, this is a huge plus that's been enjoyed for many years, and this is something you definitely could continue in your business operations and definitely take into account for tax planning. Another big provision would be the SALT, which stands for state and local taxes. There was a $10,000 cap on all your state income tax, state real estate taxes, state federal withholding, no matter what you paid in taxes. So if you paid $25,000 in state taxes and you only got the benefit of the first 10, the other amount would just essentially evaporate and there was no benefit. Now, as part of the tax provision, the SALT cap has increased to $40,000. So that is a good benefit there, especially if you itemize or you can have a larger itemized deduction. Another provision that you may have heard is the senior deduction. The essence of this is to make Social Security income not taxable. You may be surprised if you're not collecting Social Security, but if you have a loved one that is, up to 85% of Social Security is considered taxable. There's a senior deduction, which is $6,000 per person. So if their joint is $12,000, where they get an above the line deduction to save on if they are receiving Social Security and other income, as long as your income is $75,000 or less, or $150,000 or less if filing joint for that. And then opportunity zones, this has been made a permanent part of the tax code. There are some nuances and provisions based on the op zones under the old law and op zones under the new law. Some other provisions, the standard deduction at the higher amount is made permanent. Exemptions were repealed, and most of the time, nobody really got a huge benefit from personal exemptions. They were capped at like about $500. The child tax credit did increase to $2,200. And miscellaneous deductions, there was a huge area, gray area. Miscellaneous deductions has now been permanently eliminated. And the premium tax credit repayment cap doesn't start until 2026. So these are individuals that are receiving any kind of benefit from health insurance using the marketplace. There are some changes to charitable deductions. This will start now for 2026. But if you are an individual that realizes, hey, I don't get the benefit from itemizing, I wind up getting the standard deduction because it's higher, and you get to look at that every year and determine which one is the best for your tax profile. But you do make charitable donations, you get an above the line deduction of $1,000 or $2,000 for making charitable donations where you weren't able to claim those until unless you were able to itemize. And there's also a 5% floor on charitable donations. So there's a 5.5% haircut on this, and this will be effective in 2026. So if you're planning on making any large charitable donations, 2025 is the year to do that. There's some other extenders. So for example, the AMT, and if you're wondering what the AMT is alternative minimum tax. You basically have to calculate your tax on a whole set of rules and pay the higher of the two. But that has a huge exemption. A lot of people were getting caught in that because the exemption was very, very low, but that's been increased. One big point here is car loan interest. So if you have a business, you should be deducting loan interest on the vehicles you're purchasing for your business, but that wasn't extended to individuals. So this is for individuals. If you purchase or finance a vehicle in 2025, so it has to be a vehicle purchased this year through 2028, you're able to deduct the interest on the car loan. So it's up to $10,000. There's a website as to what vehicles qualify for this car loan interest. And another area that I like to discuss is the expansion of 529 plans. So most people know 529 plans to cover for college expenses and technical schools for higher education. You can use 529 plans to cover tuition from K to 12, and it's been increased from $10,000 withdrawal to $20,000. The whole point of the 529 plan is you're putting funds in there to grow, and then the monies that are earned, the earnings come out tax-free as long as you're using it for education purposes and related materials and supplies. Another extender was a mortgage interest limitation. So when you purchase a home, it's not the value of the home that is limited, it's the amount that you're financing using the mortgage. So the first $750,000 of that would be 100% tax deductible as mortgage interest. Once it goes beyond that, the indebtedness on the home, it starts to phase out. So if you have a mortgage interest that has more mortgage of $750,000 or more, you could consider getting this paid if you pay it down, increasing your mortgage interest deduction. This is something that should be looked at every year to make sure you're maximizing that. And unfortunately, casualty losses. We've experienced a lot of casualty losses in the country, whether this is wildfire, mudslides, tornadoes, or hurricanes. There was a floor on that where it had to be more, if you had casualty losses, more than 10% of your adjusted gross income. This has been completely removed and it's been retroactive all the way through 2024. But this has been extended for all of 2025 and going forward, at least through 2028. So if you know of somebody who has a casualty loss, any amounts not reimbursed by insurance would be deductible on their tax return. And then as a final component, we do have where estate planning. So if you're looking at your net worth, there is a 40% tax on your net worth, or if somebody considers this a death tax. And this was a big concern because this was doubled and was supposed to expire at the end of 2025 and presumably go back in half. So what we're talking about is your entire net worth. If it was $5,000, $5 million or less, you wouldn't pay a tax on that, or your beneficiaries or your heirs wouldn't pay a tax. But now if they made that provision permanent, so it's now $14 million for 2025 and $15 million for 2026 going forward per person. So a husband and wife or spouses could potentially deduct $30 million in exemption from their net worth before the heirs pay any tax. And then, of course, there are some new accounts called Trump accounts. This is established as an additional savings vehicle for children under 18, where if there's deposited $1,000 per year per child, their earnings grow tax-free upon withdrawal.
And are those just for children that are born between like this calendar year and through 28?
Yeah, so that's new. So that's retroactive to the beginning of the year. So that's a great point. So if there's a child born this year through 2028, you could establish at any point in time during that time frame a Trump account where you could deposit $1,000 per child.
But not for my 13-year-old.
That's correct. For your 13-year-old, we could definitely look at doing maybe a 529 plan.
Got it. Okay, perfect. Thank you.
Thank you, Rosie.
And we did have a question before we move on. didn't quite answer the question about the vehicle tax, the vehicle deductions. So somebody's asking if they spent 135,000 in gas and equipment, and they have 154,000 miles, can they deduct the expenses and the miles times 70 cents? And I think this depends on, they have to choose, right? They have to choose the method, the mile method or the expense method. But also, like, this only applies for vehicles that have commercial and personal use, right?
Right. So it's either or.
Yeah.
So, for example,
Yeah.
if this is a tow truck, which I don't expect most people driving around the tow truck for their own personal use. I don't see a tow truck driver driving to go on date night, taking their family to events, doing groceries. In that aspect, if it's a
Never know,
commercial,
right?
exactly, you never know. But if it's completely used only 100% for
Yeah.
business, you would definitely use the actual expenses incurred for that. There wouldn't be a personal component. So you're using either or. You still want to keep track of the mileage because let's say, for example, this is another vehicle that could lend itself for personal use, and there may be maybe, 100 miles, a month for personal use. You want to keep track of that so you could exclude that from your expenses, but you want to select either or. The standard mileage deduction is useful, like if you have somebody doing a quick business run. Hey, they went to Office Depot. They're maybe doing bank deposits. You don't provide them a business vehicle, but they're using their personal vehicle, and you still want to reimburse them for that. That's where we use the standard mileage deduction to reimburse that person for their own personal use of their own vehicle, some of those expenses for conducting business. I hope that clarifies that.
I hope so too. Thank you for that.
Okay.
Awesome. Thanks, Rosie. And so want to round out today's presentation, just talking about some year-end tax planning opportunities and strategies for the material that we covered. We'll go back and visit the areas that I discussed on Section 179 and bonus depreciation. As I mentioned, 179, the deduction jumped from 1.22 million to 2.5 million. So really take a look at that provision before you start using bonus depreciation. Try to use up as much of your 179 deduction and then apply a bonus depreciation. This is even more critical because, in the tax world, there's the federal concept and the state concept. And just because the IRS will grant something, states have the discretion of what's called decoupling from bonus depreciation. So you got to be very mindful that if you're applying bonus depreciation at the federal level, you might not get that at a respective state, depending on where you are filing. So that's going to be critical to, like I said, first use up 179 before applying bonus depreciation. I think I talked about this earlier. You cannot create net operating loss with 179. You can't take more 179 than you have business income. So that's going to be critical in terms of applying 179 versus bonus depreciation. From a documentation standpoint, you definitely have to track your business use percentages, especially for vehicles that are considered listed property. And then, like I said, you can elect out of bonus depreciation. And if you want, use the 40% in the first 19 days as opposed to the 100%. Everybody does it to manage taxable income. If you're going to create a loss, you might want to, elect the smaller percentage. And then, make a plan with your tax advisor at the end of the year to figure out whether you have any unused 179 or bonus depreciation. So this is going to be key from a planning perspective. And, when Robin reached out to us to have this discussion, you've got, call it 45 days right now to sit down with, the right tax advisor, have these conversations, because you want everything to be inked before December 31st. Because again, your return will be filed either in the spring or in the summer based on extension, but all what you do in these first part of the year and these next 45 days is going to be critical in reflecting your tax position when you do file the tax return. You hear Rosie?
Can you hear me?
Yeah, now I can hear you.
Okay, great. I'm sorry about that. But you can't switch from standard mileage to actual expenses on a vehicle year after year. You definitely want to visit that on the first year that you have the auto deduction for that vehicle to determine which is best. You definitely want to look at maybe your entity restructuring for tax efficiency and go back and go through your logs for tips, especially since it was made retroactive to the beginning of the year. So that way you don't have any kind of last minute number crunching to try to get W-2s out and any other kind of reporting out. As Matt said, definitely want to connect with your tax advisor, tax professional to do year-end planning. You may want to look at multi-year projection, not just 2025, but maybe also 2026 to get a really good forecast on that before you make any decisions before the end of the year.
So that brings us to the end.
And we had one more question. We have one more question, and someone's asking, can you do 100% write-offs from old years? For example, if last year you had 400K, I'm assuming they mean in sort of like a or sort of an asset purchase or something like that. If you had 400K last year, can you change them to 100% this year? The answer is no, right?
Correct. So that basically statute says you have to apply the rules that were in place. So in 2025 or 2024, it was 60% for bonus depreciation. So you could get that. In essence, hopefully the 2024 return has already been filed. The statute has lapsed with respect to that. But you can't say like, okay, now 100% bonus depreciation, because that effective date is any assets purchased or acquired after January 19, 2025. Everything from 1/1 to January 19 is 40%. Everything from January 20 to the end of the year is 100%. So that brings us to the end of the presentation. We can definitely hang on the line to see if there's any other questions. I want to put up both Rosie and my contact information. We're more than happy to have a deeper discussion from a tax planning perspective. I think, like I said at the beginning of the presentation, the uniqueness of CLA is we do focus on privately held businesses, but we have a breadth of knowledge. And so we're always collaborating with other groups where we can look at your overall position from a tax perspective to see if there's any opportunities to, stay within the confines of the law, but pay the least amount of tax as possible.
Great. I don't see any more questions. First of all, I want to let everybody know, thank you for joining. We're going to share this presentation to everyone who signed up for the webinar and make that available so you can share it with your colleagues. And thank you to Matt and Rosie. It was a really productive conversation. I learned a lot, and hopefully you guys did too. So thank you guys.
Appreciate the opportunity. Thank you guys.